You are listening to RLA Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Hey, I'm offering a free report this week titled Tax-Free Retirement Income Strategies. If you've not yet received it, I would invite you to go to requestyourreport.com. Let me know where to mail the report, and I'll be glad to send it to you, along with my best-selling book, Revenue Sourcing, and the Little Black Book on Social Security Maximization. So again, go to requestyourreport.com. Let me know where to mail you that free stuff, and I'll be very glad to do so. You know, on this week's program, I want to shed some light and do some math on the exponential growth of the United States government's debt. Now, more specifically, I'd like to discuss the cost of servicing the debt, which, by my calculations anyway, has long passed the point of being able to be effectively addressed. Interest costs on the debt. Just the cost of paying interest to the entities and countries that have loaned the U.S. government money, that interest consumes such a large portion of tax revenues that the trend now, in my view, cannot be reversed. We are now just waiting to witness firsthand the painful consequences of massive deficit spending for decades. Now, Nick Giambruno, who writes for International Man, uses a great analogy to explain the concept of exponential growth. And U.S. government debt is growing exponentially. It took 220 years for total U.S. debt to reach 11 trillion. And from 2020 to 2023, just over those 3 years, U.S. government debt increased by $11 trillion. That is exponential growth. So Giambruno uses this story. He tells the story of a mathematician who supposedly invented the game of chess, and he presented the new game to his king. The king, very impressed by the game, asked the mathematician to name his reward. Well, the mathematician made what seemed like a very simple request. He asked the king for grains of wheat using the chessboard to calculate the amount. He requested that a single grain of wheat be placed on the first square of the chessboard, 2 grains on the second square, 4 grains on the third square, and so on. So every square of the 64 squares on the chessboard would contain twice the number of grains of wheat as the prior square. Well, the king said, wow, this seems like a pretty modest request, so yeah, I'll go ahead and do that. Well, by the time half the chessboard was covered, by the time the 32nd square came into play, the number of grains was already enormous, numbering over 4 billion. As the squares continued to be filled, the numbers grew exponentially. The numbers grew astronomically larger. By the 64th square, the total wheat needed for the entire board reached about 18.4 quintillion grains of wheat. Now, let me put that into context for you. The average weight of a grain of wheat is about 50 milligrams. So by the time you get to 18.4 quintillion grains of wheat, you have 922 billion metric tons. Now, that's about 1,200 times the entire wheat production of the entire planet. So it's a great illustration for showing how exponential growth gets out of control at a certain point, even when you start with something as small as a single grain of wheat. Now, that's really what's happening with U.S. government debt. At the present time, out of every $4 collected in personal income taxes, $3 goes to pay interest on the debt. So at this point, we are borrowing money to pay interest on money that we have already borrowed. Hedge fund manager Ray Dalio, who's got really just a really good reputation for getting things right, recently said this about debt and interest costs as far as U.S. government debt is concerned. He said this, quote, "We are at a point in which we are borrowing money to pay debt service. When you keep having debt grow faster than income growth, that means you have debt service encroaching on your spending, and you want to keep spending at the same time. As that happens, there is a need to get more and more into debt. It accelerates. We are at the point of that acceleration. We are near that inflection point," end quote. So how does this play out? I'm going to talk more about this in the last segment of today's program. I'll be talking to Harvard-educated economist and best-selling author Harry Dent in the next segment, and I'll get Harry's forecast for stocks and real estate. You won't want to miss it. It is really quite an eye-popping forecast that Harry has for us today. But again, U.S. government debt, it took 220 years for total debt to reach $11 trillion. And from 2020 to 2023, $11 trillion was added. And it's getting even more debt accumulation. There's even more debt accumulation, I should say, by the day. Now, we're not there yet, but the day is fast approaching when there will be two choices as far as debt is concerned. One, outright default, or two, more currency creation, which will create an inflationary default. I'd bet heavily on the latter outcome, and it seems like that is the direction in which the Fed is now heading, with interest rate cuts beginning again soon. So certainly, if you haven't done so already, adding some tangible assets to your portfolio would be something to seriously consider. And you also might want to get this month's special report, Tax-Free Retirement Income Strategies, because along with the report, I'll send you some bonus information on this topic as well. To get your report and all the bonus information, the website is requestyourreport.com. I'll be back after these words with my special guest, Mr. Harry Dent. Welcome back to RLA Radio. I am your host, Dennis Tubbergen, and joining me once again on today's program is returning guest Harry Dent. Harry is a renowned economist, known for his demographic research and his accurate predictions as to where the market is going. He's invited all our listeners today to get his free newsletter at harrydent.com. The website, again, is harrydent.com. And, Harry, welcome back to the program.
Nice to be back, Dennis.
So, Harry, seems like same song, different verse here when it comes to Fed policy. The Fed is now going to cut interest rates, seemingly doing a victory lap on inflation. What's your take?
Well, my big question, Dennis, is what's wrong with an economy that takes $27 trillion of combined fiscal and monetary stimulation over the last 15 years to just grow at 2.2% on average? They've been doing this since the 2008 financial crisis, and for good reason. As well as anybody, I was forecasting the baby boomers would peak in spending in 2007, and we would go into a long-term slowdown between 2008 and 22 or 23 for decades before it happened. Not a few years or a few months. This was something set in stone. Nobody saw it coming. So we have the great downturn in 2008, and it kept going in early 2009. It was deeper than anybody expected. So they said, okay, we'll throw $1 trillion at it. That's what it did. First round of stimulus, $1 trillion. EU did similar. Mario Draghi told short sellers, if you short this market, I will blow you out of the water. So the central banks in U.S. and Europe said, okay, good little jolt of stimulus, good warning to short sellers, this ought to be over. Well, it wasn't over for good reason. The largest generation in history had reached their peak, and the millennials weren't due to bring us back up again until, guess what, Dennis? This year, 2024. And then something else I've been forecasting forever. This is demographics, generational cycles of spending we can time literally down to the year when it's going to start. We can time to about the year when it's going to peak. And I always been saying, way back to 83 to 2007 was the baby boom boom. And 2023 or 24 into 2037 was the rising part of the millennial boom. The millennials are different. It's a larger generation, but it's spread out over a longer period of time. So not nearly as dramatic as the boom caused by the baby boom, but it's still a positive force. And we should be now starting to benefit from that, except guess what? All this $27 trillion in stimulus and pushing the economy and overstimulating. I think we've reached what I'm starting to call now the exhaustion of demand. Everybody is traded up homes, refinanced homes every possible time. You can't do that every 2 years forever. And now I think we're just going to get to a point where, the economy just starts slowing down for no reason. And unfortunately, precisely when the millennial generation should be starting their boom. And so the fact that we have not dealt with the debts and let the economy rest and restructure as it always needs to do. I don't know if I say this enough on your show, but I tell people there's nothing wrong with recessions. If you don't want a terrible recession, don't have a bubbly boom. Don't go nuts with debt and stimulus in a boom. You have to grow, and then you have to rest, just like we do every night. So we're awake for 16, 17 hours. Then we rest for 6, 7, 8, or whatever. Try not sleeping for 3 days and see what happens. You will not just be unproductive. You will turn into a crazy person and start babbling. Okay, and so it just goes back to my thing. We have the Federal Reserve who was just supposed to regulate money supply back in 1914 when they invented it. And over time now it's come to, no, they're supposed to keep the economy going and prevent recessions. Preventing recessions is bad policy. Recessions are necessary, and they are the same ratio of sleep to waking. They hit about 30% of the time we're in slowing or recession, and 70% of the time we're growing. That is healthy and necessary, and the fact that the people who run our central bank and these PhD economists who've never had sex and run a business, or at least look like they never had sex, they definitely have never met one that's run a business, don't understand our economy. They just think, it's supposed to be a machine, it's supposed to grow every year, and we don't want to burden our poor consumers and businesses with recessions. I'll just end this little tirade with one sentence. If we don't have a recession every 10 years, we basically lose it. We lose our motivation and everything. It takes a kick now and then to keep anything going. So this whole thing that recession should be the goal to prevent recession is wrong policy in the first place.
Well, if you're just tuning in, I'm chatting today with economist Harry Dent. Harry's also a best-selling author. You can get his free newsletter by visiting harrydent.com. And Harry, you mentioned debt and, this millennial spending wave that you're forecasting. To what extent will these massive private sector debt levels affect this? We've got credit card defaults rising, automobile loan defaults rising. It seems like everybody is up to their neck in debt. Will that delay this boom that you're forecasting?
Absolutely, Dennis. And here's the thing people don't get. Everybody focuses on the government debt, the federal debt in particular. That's a quarter of the total debt. You're right. It is the private debt that is most of the debt and expands the most in a long-term boom. And that's one of the reasons we have the typical decade, like just start with the 80s, our first big boom back when I was just entering the economy and stuff. The first 3 years, 80 to 82, we're off and on recession, and then 83 into late 89 and 90 was a boom. That's a typical ratio of boom to bust, and a healthy one. The governments didn't tighten. They did have to fight inflation, but that inflation would have slowed the economy. Demographics were bottoming in the early 80s. That recession would have happened anyway, and the boom would have happened. This is the first time that in 2008 to 9, the recession was so global and so difficult that central banks just stepped in and said, sorry, we're not going to allow this. And so I know what they thought. They thought, trillion from EU, trillion from US Fed, that should be enough to get us out of this funk and back to growing again. Well, no, not when you're entering a long-term downturn, which we see, by the way, Dennis, in my theories, well, not theories, actualities, generations spend for about 26, 27 years, and then the downward side of that causes a slowdown. So we had a slowdown from 1930 to 42, and then again from 69 to 82. This happens every 39 to 40 years. And so the Fed just thought, well, we'll just blow our way out of this. Well, I'm telling you that I'm the only person I know of, Dennis, who's actually calculated the price tag, $27 trillion, 19 in nonstop deficits. We haven't had one surplus since 2001, 19 trillion in deficits, and 9 trillion in money printing. That's the balance sheet you can track, okay, of the Federal Reserve. They just inject money in. So again, it's one thing to maybe inject $1 trillion when you have a slowdown to help it not overreact and stuff, but to stimulate an economy, $27 trillion for 15 years straight, and not suspect that something's wrong with it, and not suspect, well, why isn't this working? How stupid can people be? I hate to say it. This is utter stupidity from people who are highly educated and supposed to be the smartest people in finance, and obviously they're not.
Well, Harry, when you look at government debt, I've seen estimates that we have $7 to $8 trillion in U.S. government debt that needs to be refinanced over the next 12 months. At the same time, we have personal tax revenues, $3 out of $4 now collected goes to pay interest on the debt. This seems like we're about at, the critical point. Or are we at, to quote one of your books, I think, 0 hour?
Yeah, well, we are. That is the government. Everybody. The point is, everybody's too much in debt. Businesses have borrowed at the highest rate. Consumers have borrowed at the highest rate, and everybody's refinanced their mortgages 10 times and all this stuff. It's an entire system debt problem. But it's true. The government is at levels of debt that in the past would say this is not sustainable. Exactly. You're saying we're paying most of what we're paying in interest is to pay the interest on the debt, not to cover expenditures for defense and welfare and consumer benefits and stuff. So yeah, everything says problem. And here's my bottom line gripe. I mean, in the 80s, I did nothing but turn around small businesses, and then I did that at Bain & Company for a few years before that with Fortune 100, okay? Companies have to hunker down when they get overextended, find out where they've overexpanded, cut bad debts they can't afford to sustain. Banks got to restructure that. This is what you have to do occasionally. We're always going to grow and always have to restructure. We've had now 15 years, the longest time in total U.S. history, literally, since we became, late 1700s, okay, Declaration of Independence. This is the longest period without a recession. A recession is simply a slowdown, like sleeping, where we restore our systems and rebalance and cut back. Zombie companies fail. They need to fail and get out of the way. They're taking up labor and capital and not using it productively. Debts that are not good just need to be flushed out. Again, make way for money to be recycled into better investments and debt. So this is a healthy thing. And somehow, somewhere along the way, only in the last few decades, it's become common economic thought that the Fed's job really is to steer our economy towards 2 to 4% growth every year and never have a recession again. That's what people want. And that is not, as I started off, that's not good policy. That's not what the economy wants. The economy knows what it needs, and the economy has a recession when it needs it, just like we get tired and go to sleep when we need it. So this is just the greatest perversion of economic policy in history, out of the best of intentions, but you know what that sign is. The road to hell is paved with good intentions. This needs a reality reset. And what I'm warning people, Dennis, is this has been pushed off. We did have a recession, 2008, early 2000, and into mid 2009, and stocks corrected substantially, but they blew their way out of it. That did not get to do. It only did half of its work. And then we go right back into accelerating debt and everything. And now we're far more in debt, more zombie companies, all these things than ever. So we're simply going to have a bigger reset. Everybody's saying if we do slow down, it's going to be a soft landing. I am telling you, there is no way to have a soft landing after letting this much debt. Well, that's where I started this conversation. If you don't want to have a nasty recession after a boom, don't have a crazy debt-ridden boom. Don't have a bubbly boom. Bubbles are always time when there's excessive debt, and that drives excessive financial asset prices. And those two things eventually have to collapse and get back to balance. So we've also seen the greatest, most global financial asset bubble in history. I got another number for your listeners, Dennis. $630 trillion is the total financial assets in the world. That is 6 times GDP and throughout all of modern history in the last 100 years where we've been so prosperous. That has been 2-3 times as overvalued, and we're at 6 times. So financial assets globally, that means real estate, stocks, anything but the safest bonds. All these assets are going to have to come back down to reality, which also says to people, investors, and this is the worst news I have to bring, there is nowhere to hide except for the safest long-term bonds, and that is the U.S. 10 and 30-year treasuries. Even other government bonds will not do as well. We are the safe haven. Doesn't matter. Yes, our government's too much in debt, but we're not as much in debt as most European governments, and Japan is by far the worst because they've been printing their way out of a long depression first because their demographics peaked ahead of the rest of the world. And so on and on and on. But it still comes back to you can't cure a long-term downturn any more than a business can. And any business that somebody's in is going to mature at some point. The consumer demand is going to mature, or the technology is going to mature and saturate, whatever. When you slow down, you have to restructure and refocus on new areas of growth. Businesses can't print money. The problem is governments realize they could just print their way out of this, and that's what we've done. $27 trillion in 15 years. That alone, Dennis, would have been about 8 or 9% of GDP, and we've only been growing at 2.2% adjusted for inflation. So we didn't even get our money's worth over all this money we printed and borrowed to do this. And why? Because it went to propping up a bad economy instead of refocusing on better investments and better growth areas, which is what businesses have to do when they meet a long-term slowdown. They can't print money, so they change their strategies and cut their costs. And I used to turn around businesses. I turned around 8 businesses in the 1980s in small businesses, and 3 businesses at Bain and Company. And it's all about cutting overhead.
Yeah, we're going to have to leave it there. My guest today, Mr. Harry Dent. You can get his newsletter at harrydent.com. I'll return after these words, and I'll talk a little bit more with Harry Dent. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen, and I'm chatting today with economist and best-selling author Harry Dent. I'd invite you to check out his free newsletter at harrydent.com. So, Harry really set the stage nicely in the last segment. Now the Fed's going to begin cutting again. Will it lead to another artificial boom, or is there no gas left in the tank this time around?
Yeah, I mean, like I said, they have overstimulated now for 15 years. It's another thing, important, all-encompassing law of life called the law of diminishing returns. The more you overstimulate something or overdo something, the more it takes to get less and less and less. There are diminishing returns, especially in this case. They're stimulating an economy that's already kind of dead and needs to slow down and restructure. I mean, aging, what do people aging do? Well, they eat less, they exercise more, they eat healthier. They have to adapt to aging and slowing down. What are they supposed to do? And some people do this, and I think it's bad. Some people take steroids when they get older. Steroids are just going to accelerate the stress in your body. So again, This is wrong policy. And unfortunately, governments are going to have to learn. They've done the wrong thing. I can't change that. Nobody in your audience can change that. All you can do at this point is protect yourself. They're going to get their lesson. These economies are going to collapse anyway. I think it's just about to start. And when it does, then these debts will be flushed out, and then everybody will realize you don't get something for nothing just by printing money. All the gains from printing money will be washed out. I am predicting, Dennis, that the stock markets will go back to the very 2009 lows where they started printing like crazy. They're going to wipe out this entire bubble. And again, another thing I have to say, we've had bubbles before, but they usually only last 5 to 6 years in stocks. And there have been natural bubbles. The economy's great. Interest rates are low because of high productivity, whatever. But investors get too giddy and overvalue everything. Okay. This is different. This is 100% artificial bubble. The 95 to 2000 bubble was like 25 to 29, a natural bubble. This 15-year now bubble, the longest in history, 100% funded by stimulus and artificial. So we're going to have to wipe out all those gains in stocks. And so I'm looking at real estate going back to the 2012 lows, which is not that long ago, and stocks going back to the 2009 lows. That is 86% for the S&P 500. That is 60% for the average house, and that's going to be the most painful thing if this happens.
Harry, 86% in stocks. That is a remarkable forecast. Same in real estate. I mean, we're talking really, you're forecasting 1930s level performance of these assets.
And you know why? I mean, recessions follow normal booms, okay? Depressions. And the last time we saw a depression was the 1930s. That followed the biggest bubble boom in history back then in the Roaring 20s. That was a bubble boom. The demographics weren't that strong. It was totally a bubble, and stocks went up crazy. Real estate did not bubble, by the way, because financing for houses was not easy. It was 50% down, 5-year term. So the real estate did not bubble like this time. It was stocks. And stocks bubbled like crazy for several years and then crashed 89%. That's what you expect. If you get a bubble boom in stocks, you shouldn't expect a 50% correction like in the 1970s and early 80s. After a natural boom in stock, peters out, you expect a bubbly crash. Don't have a bubbly boom. If you have a bubbly boom, you're going to have a bubbly crash. So this is what anybody who studies history, Dennis, should expect this. There is nothing else that makes sense to expect. This bubble, I cannot even compare it to past bubbles. Yes, in its slope and intensity, but no bubble in stocks has ever lasted 15 years like this. And real estate, this real estate bubble dwarfs the first one that went down 34%. And that's the most real estate's ever crashed, even in the Great Depression. And it more than dwarfs the more minor real estate bubble in the Roaring 20s. So I'm just looking at the facts, Dennis, and I don't work for Merrill Lynch or any major firm. I can say what I need to say and see what I need to see. I don't have to be kosher. And this should be obvious to anybody that looks at the facts here. Biggest bubble in everything, and it's global. So if it's more global, and the Roaring 20s boom was not as global because half the world wasn't even awake back then, more than half the world. So this is serious. That's why I'm warning people. I agree with most financial advisors. 9 out of 10 times, you just sit through corrections, you rebalance coming into them. If things get too crazy, you get more conservative, but you don't just get out of everything. And then you rebalance when it corrects and stuff. But this is not that time. This is like 29 to 32. You will not see stocks get back to these prices for 25 to 30 years, if ever. And I say if ever, because in the past history, we always had new generations bringing us to higher levels. We don't have that. The millennials only bring us back to where the baby boomers took us when they mature, a decade or so from now. And they don't take us to new heights. And then there is no boom in generational demographics after that so far. It's only down after that. We're a maturing nation. And if you don't think a country can mature and die, look at Japan. They died back in the early to mid 90s, and they have stimulated way more than anybody else, and they still can barely grow, and they are going to see another huge crash and never come back from it. And China is going to have the worst crash, especially in real estate, and never see those levels again. And they're an emerging country. People don't realize China's one-child policy is catching up with them. And even when they let it go recently, people now, they're decided, I don't want to have two children because they cost too much. We'd rather have one child and get them into Harvard or Stanford. And that's the number one Chinese goal. So again, this stuff is just bubbles. A bubble is going to always burst more than a normal boom. And every boom has a bust to consolidate, just like, and every decade, we've had a recession every decade until now. First time, 15 years, no recession. So most people would say, oh, that's a good sign, so this will be mild. No, that's a sign this recession will be stronger, not less so. There's much more to clear out. And my God, you look at debt levels, you can't even compare this to the roaring 20s and the debt bubble back then. Can't even, global, this is, on the debt level, this is off the charts. There is no soft landing from this.
Harry, very quickly, I know we've got about a minute left or so. U.S. Treasuries, you mentioned, might be a safe haven, or you're forecasting it'll be a safe haven. Certainly, U.S. government finances are deteriorating. Do you say that just because it's the proverbial, best house in a bad neighborhood?
Yeah, that is exactly the word I use. And 2008 proved it. I tell people the best way to picture this downturn, 1.5 times as bad, is 2008. Instead of a 57% S&P down, 86%. Instead of 11% unemployment, 16%. That sort of thing. So it's just going to be deeper. But in 2008, at the worst of it, guess which currency went straight up? U.S. dollar. Exactly what you said. It's not a great currency. We have too much debt. We're going to have to restructure like everybody, but we're the best house in a bad neighborhood. And particularly our Treasury bonds will be the preferred investment, not just for our investors, but for the world. And 2008 proved that. I have to argue with people like Peter Schiff, and he's down here in Puerto Rico. He says gold's going to be the safe haven. Gold looked like it, in 2008 at first, and then in the end, it went down 45%. Now, it wasn't the worst place to be, but it was not the safe haven. The Treasury bonds back then went up almost 50% in 2008. Only thing that went up in that crisis. I think this time they're going to double in value. My target for TLT, which is a combination of 10 and 30 U.S. Treasury bonds, it's at 100 today. My target is 186. It's going to roughly double in the next few years in a crash when everything else is going down. And people say, well, what else can I do? I said, not much. AAA corporates, AA corporate. I mean, the safest bond, but there's no better one. No bond's going to react better than U.S. Treasuries. And again, if you don't think so, go look back in 2008. How did gold do in the end? Not bad, but still down. What other bond? No, not good. The highest corporates and the Treasury bonds were the winners, period. Nothing else. It was an everything burst. And this is going to be more so.
Well, my guest today has been Mr. Harry Dent. You can subscribe to his free newsletter at harrydent.com. Harry, always a pleasure to catch up with you. Thank you for your time today. Love to have you back down the road.
Okay, thank you, Dennis.
My pleasure. We will be back after these words.
Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. And thanks again to my special guest, Mr. Harry Dent, for joining us on today's program. If you've not yet requested the special report that I'm offering, it is titled Tax-Free Retirement Income Strategies. And when you visit requestyourreport.com and request that report, I'll also send you a copy of my best-selling revenue sourcing book that contains a retirement planning strategy for the current economy. I'll also send you a copy of my Social Security maximization book. So to get all those free resources with no obligation, visit requestyourreport.com. Let me know where to mail them, and I'll be glad to get them out to you. In the first segment today, I talked about exponential growth, and I talked about exponential growth in the context of U.S. government debt. U.S. government debt increased by about $11 trillion from 2020 through 2023. Now, it took 220 years for U.S. debt to reach $11 trillion, and yet in just 3 years, we doubled it. U.S. national debt right now is more than $35 trillion, about $35.4 trillion to be exact. And that growth is occurring exponentially. We are now at the point that we're borrowing money to pay interest on money that we have borrowed previously. We are approaching an inflection point, and I bring this up today because if you aspire to a comfortable, stress-free retirement, it is something that you will likely have to pay attention to and plan for, and it's a phenomenon, really, that your parents and grandparents didn't have to think about. Now, when you talk about exponential growth, past guest here on RLA Radio, Dr. Chris Martenson, used this analogy to illustrate exponential growth. He said, just to imagine for a moment you're sitting in a big sports stadium. Let's assume you're sitting in Yankee Stadium, and just imagine for a minute that it is watertight. Now the stadium begins to be filled with water. The first minute, only 1 drop of water is added to the stadium. The second minute, 2 drops. The third minute, 4 drops. The fourth minute, 8 drops. You get the idea. Every minute, the number of drops of water added to the stadium are doubled. Well, if you're sitting in the stadium, you initially don't notice anything. However, if you're a mathematician and do the math, you realize the stadium would be full of water in less than an hour, and as it fills, there would be little time to react. The math tells us the stadium would be full in 50 minutes. That means the stadium is half full in 49 minutes. It's a quarter full in 48 minutes. It's an eighth full in 47 minutes. So the stadium goes from being 1/8 full to full in 3 minutes, and there's little time to react. That is the nature of exponential growth. U.S. government debt is now growing exponentially. As I said, it took 220 years to accumulate $11 trillion in debt, and yet from 2020 to 2023, we accumulated another $11 trillion. Now, U.S. government debt is now at $35 trillion, and about $7 trillion, by my estimate, is going to have to be refinanced over the next 12 months or so. $35 trillion at 4% interest is $1.4 trillion per year, which is more than the outlay for Social Security. At 5%, it's between 1.7 and 1.8 trillion, which dwarfs the layout every year for Social Security benefits. So U.S. debt is growing exponentially, and the rest of the world is noticing. Now, the U.S. dollar is still considered to be the strongest currency in the world, and I don't think you'd find anybody to argue with that. But this de-dollarization trend, this move away from the dollar, is becoming increasingly apparent. Saudi Arabia, as I talked about on my Headline Roundup newscast last week, added about 120 tons of gold. Their central bank did. So a year and a half ago, Saudi Arabia said, we will now consider currencies other than U.S. dollars if you want to buy oil from us. And Saudi Arabia is starting to build their gold reserves. Central banks around the world are doing the same. Many of them are moving away from the dollar, but many of them are also adding gold in its place. Now, if you take a look at what central banks have done, central banks in 2023 had net gold purchases of more than 1,000 tons of gold, 1,037 tons of gold to be exact. It was the second straight year central banks added more than 1,000 tons to their total reserves. In 2022, central bank gold buying came in at 1,136 tons. It was the highest level of net purchases of gold on record by central banks dating back to 1950, including since the suspension of the U.S. dollar's backing by gold in 1971. The World Gold Council did a survey. It was released in June. The survey found that 29% of central banks plan to add more gold to their reserves in the next 12 months. That's the highest number since they started the survey back in 2018. And oh, by the way, only 3% said they had plans to decrease gold reserves. So why am I bringing this up today? Well, if you're planning on retiring and you aspire to a comfortable, stress-free retirement, if the rest of the world is diversifying from U.S. dollars, does it make sense for you to think about doing the same on some of your money? I would argue that it probably does. That's why I would invite you to get my special report this month titled Tax-Free Retirement Income Strategies. And when you do request that report, you'll get the revenue sourcing book, which contains a retirement planning strategy for the current economy, including this de-dollarization move that's occurring all around the globe. So to get that information, all you have to do is visit the website, requestyourreport.com. The website again, requestyourreport.com. Let me know where to mail the information. I'll mail the report. I'll mail the revenue sourcing book. I'll also mail a copy of the Social Security maximization book. And if you're not yet a subscriber to my weekly newsletter, visit retirementlifestyleadvocates.com and subscribe. It's free, and you'll get my update every week in your email. Again, absolutely free. That's all the time I have for this week, but I will be back again next week with my first-time guest on the program, Mr. Bob Hoye. Have a great week.